welcome everyone. I'm really glad that you're here. We are dealing with technology just like everyone else is in the world, right? So I'm Julie Keys, and I'm the president of the Exit Planning Institute chapter here in the Twin Cities. Some of you I know, and some of you I don't know. I think that we have a few people who are actually new to the chapter and haven't attended a meeting in the past. And so if you just want to pop in a message in the chat box, if it's your first meeting, it would be fun for us all to know if you're new. We are covering a topic today that we haven't covered in quite a while. So just to give you a little bit of background, the Exit Planning Institute chapter here in the Twin Cities was launched in 2016, so 4 years ago in May. And you can go to the next slide, Terry. And we used this particular topic, let's dissect a buy-sell agreement, and I believe it was like 3 or 4 months after we launched. And it was an interactive topic where we had people broken out into tables and we had an attorney leading each of the tables, which was the way that we were actually going to conduct this meeting today. But, you know, we had some issues already with technology. Can you imagine if we would have had all these people in the breakout rooms and everyone had a different system? And so we just decided that we didn't want to mess with losing people as they're trying to come back to the meeting room. So instead, we are going to be conducting this as a panel. And Terry Kravosha is going to be leading that. But before we go to that, I just wanted to give you kind of an insight into how this whole EPI chapter works, right? Can you go back to the sponsor slides too, please?
You bet.
Mm-hmm. You know, we're here for education, right? We're here to learn best practices in exit planning, but we're also here to build a network. And yesterday, when I was recording my podcast show, I had Nikki Vincent as my guest. Some of you know who she is. She leads the ACG chapter here in the Twin Cities. And I always ask my guests at the end of the show, give us a couple of takeaways for our business owner audience to be able to apply right away. And she said something that I hadn't heard for a while, but it's so true. And that is, don't wait to build your network until you need it. Build your network far earlier than that. And I just think that that's one thing that we're still trying to do here, right? Even though we're meeting virtually, we're still staying connected. We're still growing our network. And I would strongly encourage you to reach out to the people that are in the chapter, have a virtual one-to-one on Zoom or a group. Hopefully you won't have the same issues that we had this morning. But even if you do, so what, right? Shake it off and move on. I just always say that your network is your net worth. So those are my words of wisdom for the day. I would like to, first of all, congratulate Terry Kravosha for passing her SEPA exam. She is now a certified exit planning advisor. Congrats, Terry.
Thank you.
And Todd Crow, who has been a member of the EPI chapter for a long time, is, since the beginning actually, is going to be getting certified as well. So Todd, good luck with that. I'm sure that you'll do really well, and I know that you'll really enjoy it. So just a little bit for those who are new, I just wanted to kind of overview a little bit of the meeting structure that we've had over the last few months since the pandemic. March was our last in-person meeting as a chapter, and I wasn't even there. I was out of town. And I understand that it was right after kind of the announcements, that there was a lot of fist pumping and elbow bumping and no shaking of hands. And then we went into triage. And we had several sessions, many of you were probably there, where we were in triage. And we had a session every week from the end of March through the end of April. And then in May, we had a joint meeting with Club Entrepreneur. So for those of you who are new to the chapter, I would encourage you to go to our YouTube channel and subscribe. And then, you know, listen to any of the meetings that are listed there. We just started doing that, but we're going to continue to do that going into the future, even when we start meeting in person, which we're not quite sure when that's going to happen, but you can always count on having us holding a virtual meeting every month. So at this point, I would really like to introduce our sponsors. And if you are a sponsor, please unmute yourself. We're not going to be able to see everyone because we have so many people in the meeting today. But if Brent Engelbrecht with Sunbelt Business Advisors is here with us today, Brent, are you with us? I don't think Brent is here. Okay. Terry, I know you're here. Would you please tell us about Maslin as a sponsor for the chapter?
Yeah, absolutely. And we're so delighted to be connected with EPI. I'm so grateful that Julie and I connected, and we're just excited to be part of this partnership. Maslin is a firm that helps business owners as they're growing and scaling with all of their various needs. We can provide general counsel services to the extent companies don't have somebody inside the company. And we really help those individuals figure out everything from how do I start, how do I negotiate some of my joint ventures, what is my business planning looking like, and all the way through to what you're thinking about in terms of exits. And we're, like I said, delighted to be part of the Exit Planning Institute.
Awesome. Thanks for joining us today. All right. So let's see. Bob Georges, you said that you're here. If you want to go ahead and give us a commercial, it says that you're unmuted. Oh, you can't unmute. So Terry, since you are now listed as can you go ahead and unmute Bob Georges, Sean Sima?
So if I could see all of them, I would.
Just go into the participants, click on participants at the bottom, okay?
Well, for some reason, I don't have that. Hang on. I think I might have to stop sharing for a minute. No, maybe not. Oh, here, I got it. Okay. Who am I looking for now?
Bob George.
Bob Georges.
And under Robert. Yep. Okay.
Yep.
Allowed to talk. There we go.
Good morning.
Hello, Bob.
Hello, Julie. Hello, Terry. Hello, Michael. I haven't seen you in a while. Good to see you there on the panel.
Thank you.
Very good. I'm Bob Georges. I am with Wilkerson Guthman. We are a CPA firm that for the last few months has been working with all of our closely held clients, trying to figure out how to help keep them afloat. Obviously, some are doing very well this time of year or during all this crisis. Some are struggling more, and we have been working fast and furious like all the rest of you, trying to help keep them figuring out how to get through the next step. But that's what we do, is work with closely held businesses and their owners. We've been doing it for a long time, and we're delighted to be a part of EPI.
Well, we're delighted to have you. Thanks for being here, Bob, and thanks for your support for the chapter. Terry, could you please unmute Sean Sima and Mark Hegstrom?
Yes. There's Sean. And okay.
All right, I think this is working. Good morning. My name is Sean Sima. I'm with the accounting firm Sima, Flotimish, and Ornstein. And we've got a firm downtown. It's kind of, I would say, considering the COVID situation, you know, downtown Minneapolis is kind of like a ghost town. I think we're probably about 10% of the people are in our building. And like Bob said, you know, we work primarily with small businesses and their owners. And our primary focus right now is kind of working through this whole COVID shutdown and the transition back online. We spent a lot of time working with business owners securing the PPP loans, and the next step will be securing the forgiveness. And we also have several clients that are, you know, still considering exits and planning for exits, and so we continue to work with them, address valuation issues and, you know, deal structure. And so again, just kind of working hand in hand with businesses. And so thanks for joining us today.
Thanks for your support, Sean. Good to have you here. All right, can we pull Mark Hegstrom up, please?
You bet.
Hey, everybody. Glad to be here. Glad we got this thing working. I am Mark Hegstrom. I'm an owner of Boss. We're headquartered in Edina, but we work all over the country on a virtual basis. We help business owners with exit planning, financial planning, and 401k plans. For exit planning, we've got a 9-module program, and each one of those is delivered in 90 minutes. They're all delivered virtually, and the business owner's done in 90 days. 9 modules, 90 minutes, 90 days. We think business owners want to plan, and yet 90% don't have plans. We think this is because they don't know how to get started. We think this program that we've put together is a great way for almost every business owner who doesn't have an exit plan to get started and feel good that they've begun the process. Our firm is called Boss Business Owner Succession Strategies. Thanks.
Excellent. And thank you for your support, Mark. It's good to have you here.
Thank you.
All right. Is Susan Stiles in the house?
I don't see her.
I don't see that Susan's with us today. She was signed up, but she probably got in a snag. You know, those things happen. So if she joins us later and we're able to pop in and have her give us a short commercial, that'll be great. So we'll watch for her. All right. So I'm going to go ahead and introduce our speakers, and then we're going to let them take over. I just want to let you know that we're gonna have Terry's probably going to run the show with this. She's got a little bit of presentation. Everybody's going to present a little bit, but we're going to be answering some questions that have come in already. And then we're going to open it up if we have time. So if you've got a question that hasn't been addressed, please use the chat, not the chat box, use the Q&A box. That would be best. And Terry, you can just, go ahead to your slides if you want to. This is just our upcoming meetings. I'll talk about that at the end when I wrap up the meeting. We don't have to worry about that slide because everyone will get that information in an email anyway. So, and then by the way, you'll probably get a copy of the recording in an email too. So watch for that in the future. We're going to just start with introducing Terry. Terry, like I said, is a new certified exit planning advisor. She specializes in working mergers and acquisitions. She's also a qualified mediator, which is very unusual, unique, very cool. She works with closely held businesses, and we're thrilled to have her here.
Thank you. Can everybody see my slides okay?
Yes.
Yeah.
All right. Well, like I said, we are delighted to be part of EPI. I need to give a shout out to Bob Morse as well. He and I met at an EPI, or I think at a luncheon at St. Thomas, and he's really the one that told me about EPI. So I'm very grateful for his introductions initially. So
Terry, hold on. Terry,
Pardon
hold
me?
on. I want to introduce the rest of the panelists real quick.
Oh, sorry.
Yeah. All right, so Adam Dorr is also an attorney at Maslin, and welcome, Adam. Thanks for joining us today. He also specializes in mergers and acquisitions, divestitures, and internal reorgs. So very cool background. Corporate governance as well, operating, compliance, and contractual matters. Adam, thanks for joining us. Susan Markey is also an attorney at Maslin. She represents clients in general corporate and taxation and nonprofit matters. She has a background in government and in accounting. She also has a specialty in tax controversies, audits, appeals, and planning. So Susan, thanks for being here. Thanks for your expertise. And then last but not least, Michael Sampson. Michael has already, it's been a while, right? A couple of years, I think, since you presented for the chapter. Welcome back. Cool to have you. And he focuses primarily on high-end estate planning and tax planning, trust administration, charitable giving, and business succession planning. So welcome to this Maslin team, and they're going to take it away from here. Thanks, you guys.
Okay, thank you, Julie, and we're delighted to be here, as I said, and we'll look forward to having a conversation with our panel in a few moments. I thought I would start out today and just talk a little bit about what is a buy-sell agreement, and when do you use it, and give you some of the high points, and then we'll talk about best practices when we get to our panel. So very simply, a buy-sell agreement is an agreement among the shareholders or members of a company regarding how the equity is going to be transferred. I often refer to them as business prenups, because the prenups are something that you do, in a regular marriage, and when you're starting to work with a business owner, it's very similar to that sort of situation as well. So I look at it as an important opportunity and key component for business owners to provide protection and facilitate guidelines for company during a transition. To use the Exit Planning Institute language, it really addresses the 5 Ds: distress, disability, disagreement, divorce, and death. And we'll talk about those a little bit further as we go through our time together. And in large part, it is a risk management tool to take care of potential risks up front so that you have an opportunity to protect yourselves going forward. So why would a business owner want to buy, sell? So, and all these examples that I'm going to give today are real. So I've changed them a little bit to protect those that were involved, but these are real examples from my practice. So you've just entered into business school with a friend you met in business school. You don't know much about each other, or you've been best friends together. You find a third person that you want to enter into business with, and you all have dreams that the business you want to start will grow and flourish, but it's going to be in an area you know nothing about. And you really think, well, what do I need to know anything more about this business? I'll be able to grow the business and everything will develop well. What could ever go wrong? Well, early on, these shareholders, they actually, I didn't start working with them until a little bit later, but they developed a good buy-sell agreement, and it addressed what would happen if during the time the owners were employed by the company, one of them needed to be terminated. So lo and behold, one of the business owners who was more used to working with larger companies and had really never started a company before, thought it would be a good idea to share some confidential and sensitive information from one of its customers with another of its customers. And we found out about that, and the company decided it needed to terminate this individual. Their buy-sell agreement provided that they could be terminated for cause, and he met the cause definition. The individual was terminated, but what wasn't in the buy-sell agreement was how they were, whether they had an opportunity to buy his shares back when he was terminated, and at what price. So it addressed one of the issues about what happened in a for-cause situation. We ended up with a mediation, and finally were able to settle the case. But these are the kinds of things that happen, and I'll sprinkle these throughout my talk this morning. So what I also find is that as a company is getting started and developing, there are a lot of things that owners have to figure out how they're going to allocate their funds, and legal and a buy-sell agreement is not often something they want to spend money on. Or even worse, they think they can pull something down from the internet or cobble something together between a few different documents, and oh, well, this sounds legal enough, we'll just use this. And then often the situation starts to fall apart because of one of the 5 Ds that I referred to earlier. And one of the things that we often do is provide for our clients an opportunity to do their startup documents for fixed fee. So that gives us an opportunity to kind of help them with the cost. It's the investment we make in our clients, and we provide them with a good questionnaire so that the owners themselves can kind of dig deep into these 5 Ds and figure out how they want to deal with them, and then we can help them put together a document. So we've got a good process that we've developed as well. Here's another example. This is one that I'm dealing with right now. So you have a stepbrother who's the CEO of a company that was started by his stepdad. Dad died several years ago. Dad's 2 sons and his stepbrother and Dad's wife entered into a buy-sell agreement about 10 years ago after Dad had died. The Dad's wife, the stepbrother's mother, owns all of Dad's stock between herself personally and a trust. The business is doing well, even so well that it's now started to develop face shields as part of the whole COVID-19 situation. And stepbrother decides to fire Dad's 2 sons that are working for the business. One he gives a severance to, and one he doesn't. The buy-sell agreement gives all 3 of those individuals a right to buy mom's stock if she becomes disabled, except that right only applies if each of the individual or the individuals who want to buy the stock are then employed by the company. So mom is getting older, and it looks like the CEO wants to make sure he can buy all of her stock. And as we look through the documents, we're thinking, it looks like maybe stepson is trying to put things into the right bucket so that he can buy all of her stock. We'll see what happens. But again, This is another situation where business owners signed an agreement not knowing what it said. Had the parties all understood what the document was doing, then the issues could have been addressed at the time. And that's another challenge that we often find with buy-sell agreements, is that individuals sign things and they're really not aware of what they've signed. Adam and I have a different situation where three parties entered into, two different companies entered into really a joint venture. There was a board of 3 people, but the one of the board members had a veto right to veto anything the other 2 wanted to do. They all claim they didn't know that right was in there. The one who had the veto has indicated that he hasn't been able to, that he would never use it, but he also indicates that he wasn't aware that he had it. And so we're working through that with that client as well. What could happen without a buy-sell is that one of the owners dies and the spouse succeeds to his or her stock, and the other owners then find themselves a partner with the deceased spouse. They never liked the spouse much anyway, and now the surviving spouse holds the company hostage for payment. Or let's say one of the owners enters into a personal bankruptcy, and then the bankruptcy trustee becomes a partner in the business. So without a good buy-sell agreement, you risk then bringing others into the business that you had never thought would be part of the business. So let's look at what the options are for these 5 Ds and how they're typically dealt with in a buy-sell situation. Most often, and this is in businesses that are not family businesses. Family businesses have a whole different dynamic to them, and that might be an opportunity for another EPI meeting, but let's focus now on non-family businesses. In the event of a death, typically the company is allowed to buy out the owner's interest, and oftentimes that's mandatory, so must buy out the owner's interest and then pay the owner's estate for the value of the shares that the owner who died owned. Oftentimes life insurance is used to finance that cost, and that way the estate receives the value of the shares. The company doesn't get a partner that they didn't plan on. In a divorce situation where you have an individual who is an owner and then is going through a divorce, if you have a situation where the divorcing spouse becomes entitled to own the stock of the company that the divorcing spouse owned, oftentimes the typical way you deal with that is that the owners have an option to purchase, the other owners have an option to purchase the divorcing owner's interest. They can decide then whether they want to do that. Typically the option is in a pro rata proportion to the shares, the number of shares that they own. And it's usually often given first to the company. If the company doesn't want to exercise it, it's then given to the shareholders. Disability is typically dealt with on an optional basis, similar to divorce. There is disability insurance you can get to enable either a company or cross-purchase among different owners in the event of a disability, but it's very expensive and often not done. And so it's an optional situation. It's important in these sorts of situations to define what do we mean by disabled. And there's a legal definition that you need to use and make sure it comports with what the law requires at the time the buy-sell is entered into. And so it's also important to think about things like, if one of our owners, if we're all working in the business and one of our owners becomes disabled, then do we want that individual to be able to continue to be a passive owner, even though that individual will not be able to work in the business? It's often hard to think about those things in advance, but it's much better to think about them in advance than to have to think about them as they are occurring and before you've had an opportunity to really deal with them on a global basis. In a distress situation, and I would say that's a situation where an individual goes into some sort of financial distress, a bankruptcy. You could end up with the bankruptcy trustee as a partner in the business as well. Those are treated typically the same as divorce and disability in terms of optional participation. Disagreement is a situation where you have a deadlock and some sort of disagreement about the business. I find I do a lot of what I call corporate divorce work, where business owners are trying to get out of a business and want to part from working together with each other. Sometimes it's deadlock in the business. Sometimes it's just a challenge because the individuals don't understand or know. They've sort of lost ability to be able to trust and work with each other. It's mostly trust. Is the way that I think it manifests itself most of the time. There's something we often use in this sort of situation called a Russian roulette provision, which is a situation where what happens is one party gets to say to the other party, it's typically when they're 50-50 shareholders, one party says to the other party, I don't want to be in business with you anymore, and here's the price that I'm going to offer for my shares, and the other party gets to decide whether they want to be the buyer or the seller. Sort of like when you say to your kids when you're little, you can one gets to cut the cake and the other gets to decide which piece they're going to take first. But as I was thinking about this last night, I will tell you, I don't think I have ever had I've put this sort of provision in many buy-sells over the years. I've never seen it exercised in a way that's worked. And I think often, as I started to think about it more last night, I think that these sorts of provisions are helpful to put in, and I think what they serve as is a catalyst to get a conversation going between two 50-50 shareholders to figure out how to split up. And so I would still recommend, it's very critical when you've got 50-50 shareholders to put in some sort of unwind mechanism, but understand you can always negotiate something different if the parties are willing to do that. And that's most often what happens. The other things you can do in a disagreement situation, and particularly if you don't have 50-50 shareholders, is to have to deal with use puts and calls, which means that an individual owner might have a right to put the amount of or the shares that they own to the company or the other owners for them to buy, or a call would be a requirement where the company has to redeem the shares. Somebody asked a question before early on when we were preparing this about who enters into a buy-sell agreement. Typically, it's all the owners, but I have done situations where you have sort of what I would call a one-sided buy-sell. So let's say you have one owner of a business who's then going to hire a COO and give them some stock or let them buy some stock as they're working for the business. I have done buy-sell agreements where you're only binding the new employee COO in terms of how that individual can transfer or sell their shares. I mean, this is all about what an individual owner can do in terms of transferring or selling their shares. And oftentimes those will be very one-sided. They will make a requirement on the COO in terms of what that COO can do to transfer its stock, but then there's no requirement on the owner of the business in terms of what they might want to do if they decide they want to exit the company. Or you might have a provision called a drag along, which would require the individual who owns the minority interest to agree to have their stock sold if the majority owner decides they want to have their stock in the company sold as well. So at what price is the stock purchased? Typically, there are three choices: certificate value, appraised value, and formula value. And often an agreement will say that once a year, once every 15 months, the company will decide what the certificate value ought to be. That's just what they decide the value of the shares are. It is, my experience has been when you put that in as a requirement, it almost never happens. Companies forget, they don't have contact with their lawyers on a regular basis, they don't identify what the certificate value is. And oftentimes what we do is we'll say that the appraised value or the formula value will be kind of the next way to value the company if it turns out that there has not been a certificate within a certain period of time when the event that's causing the valuation happened. So let's say, for example, there's a death or a disability, and the agreement requires 15 months, certificate value having been decided within 15 months. If that hasn't been done, then you might fall into a second valuation option, which would be either an appraisal or a formula value. We'll talk about this a little bit more in the panel. And there are different reasons why a formula value would be just simply that, a calculation of how you figure out the value. That changes over time, right? It depends on how mature the company is, what you're going to use in terms of your formula. An appraisal, though the most expensive option, is probably the best option to get at what the value that a hypothetical buyer would pay a hypothetical seller. And then you have to deal with issues of discounts. If it turns out you're selling a minority interest, is the seller going to be required to take a discount on the value of their shares because they're selling a minority? Although, what if they're selling a minority interest to an owner that once they receive the individual's minority interest will then own a majority? So all sorts of negotiation that can go on. And if you hear discussed what a liquidity discount would be, all that means is the shares aren't readily tradable. You can't call your broker and say, trade these shares for me in this privately held company. So sometimes there is a discount for that as well. And we'll talk
Harry,
about
do you ever think about discounts when, for example, somebody's being terminated for cause? You might set the price at 80% versus if somebody dies or gets divorced.
You know, I never have, but it's actually a good idea, Mike. I mean, you certainly could, for cause, for sure. If you're terminating somebody for cause, my view on that is always, well, why should we pay them their full value if they've, been a liar, a cheater, or stolen something from our company? In the case I mentioned where we had that situation, in the end, we paid the guy what we thought was more of a fair market value. But you're right. I mean, and it's whatever the owners can decide they want to do, right? I mean, that's the point here is think about it. And then once you think about it, you can figure out how you're going to deal with it. Terms for purchase, if there is insurance, life insurance, for example, usually what the terms are is the buy-sell agreement will say that there will be a down payment of the amount of the life insurance, and then the balance will be paid over time. I often see 5 years with some sort of market or variable interest rate. If there's not insurance, like I said, that oftentimes there's a down payment of 10, 15, 20% in cash, and then some sort of payment over a period of time, often 5 years, which will often accelerate if the business is sold in the meantime. And then you have to think about how's the business going to be run in the interim. I have a corporate divorce on my plate right now that I'm working with where there will be a 5-year payout. And as I was revising the agreement last night, I put in some covenants about how the individuals ought to run the business before they've paid off my client who's going to be bought out. I'm sure there will be a lot of negotiation about this, but I want to make sure that there's going to be money in this business to pay my client out. And it's hard in a privately held business to figure out what that security is going to be. Oftentimes, what's negotiated is a pledge of the equity interests back to the individual that sold their interest. But that's usually the last thing they want. They want to get out of the business. They don't want it back. In the one I'm working on right now, we decided rather than just asking for the 50% interest to be pledged, we're going to ask for a majority interest to be pledged back, so that if the individual doesn't get paid, not only do they get to take the company back, but they get to be the majority owner. Stay tuned. I can report later about whether that came in or not. And then there's all sorts of tax implications. In this deal I'm working on right now, we're trying to negotiate what will be allocated to covenant not to compete in ordinary income, what will be allocated to the purchase price, how that will impact the company in terms of its ability to deduct the cost of part of the payment, and how that will impact the net proceeds that the owner who's being bought out will receive. So it's just very important you get good tax advice during that time as well.
Terry, there's another valuation issue there too, which is if the company has life insurance and you value the company with that death benefit in the company, it's worth way more than it would be without that death benefit. So on your first bullet point, if the company is required to use that insurance money to buy the deceased shareholder's stock, you have an offsetting liability so that value isn't subject to estate tax in the shareholder's estate. So that's another angle people sometimes don't think about.
Yeah, absolutely. No, that's absolutely right. Put or call rights, we can talk about those for a moment, but as I mentioned earlier, a put right is when a stockholder has the right to require the company to purchase his or her stock. In the deal I mentioned working on right now, where COO is going to come work for a business and is going to get some stock ownership for the business, what we're trying to negotiate, and this is a family business, this COO is never going to own the entire business. And he's at a point where he's happy to work for the next 5 to 10 years, but then wants an opportunity to be able to cash out his ownership. So I'm going to give him a window of time when he can put his shares to the company and require the company to purchase them from him. And what about a situation where a company might have the right to require the stockholder to sell his or her stock to the company? That would be my cause situation that I had, where you end up terminating somebody because they have committed some sort of cause against the company. You want the right to buy their shares back. And then to Mike's point earlier, what's the price going to be? Should there be a discount to buy their shares back because they were a bad actor? So something to think about as well. I want to shout out to Kevin Sullivan. I'm not sure if he's was able to attend today, but he's one of our members in New York. And he sent me an interesting case that was being tried in the New York court system called Yakul versus Gluck. And I'm happy to give anybody the site if they want to. Short story about this one is, and really, you can't make these things up. Gluck and Yakul amended their buy-sell agreement that allowed the company to purchase, I think it was Yakul's shares at any time, and then to summarily fire him. Are you kidding me? I mean, and they both signed it. Did they read it first? What was interesting is there was a litigation that ensued not about the right to purchase the shares at any time and fire him, but about what the value of the shares were going to be. So maybe they did both read it, but they certainly didn't have a good agreement about valuation. Okay, so I want to spend some time now with our panel discussing best practices. And I think, was there one question? No, it just says thanks, Julie. So maybe
there are two questions, Terry. The first one is
okay. Go ahead.
from Scott Schneiderman. He says, "What's your guess about how often the 5 Ds actually happen, and which one is the most common?"
Mike, you take the first one on that one.
Well, gosh, I hate to break it to you if you didn't know this already, but everybody is going to die at some point. So since that's what I do for a living, right? Death does happen fairly regularly, and divorce as well. Disability isn't as common. Distress isn't uncommon. I think it depends on the business. With divorce, I think was the other one. but I think they do happen. I don't know that they happen to every business. But it's like I think a buy-sell is like bringing an umbrella on a picnic. It's better to have it and not need it than the other way around.
Yeah, I think that's true, and I think that's absolutely right. I mean, and there may often be something that you haven't counted on, but that is just something you need to think about. I see some of these other questions, and I think we're going to get to them in a couple of minutes. So we will go through and reach the answers to the other questions as well.
Terry, I'm going to make a real quick comment about the 5 Ds.
Sure.
And, the statistic tells us that over 50% of business owners will suffer from at least one of the 5 Ds in their business life cycle, and the older they are, the higher the likelihood that they will suffer. And when we think about it, we've just all lived through distress or disaster.
Yeah, no, that's absolutely right. That is absolutely right. And I mean, I think one of the things I would also say is that there will certainly be something you didn't count on. I mean, even if you have a good planning process, but what the planning process does is give you a rubric to fall back on about how to deal with things that you might not be able to deal with had you not been through that process. So that's why the process is really, so important as well. Okay, so Mike, my first question is for you. And what are some differences to be aware of if the business is either an S Corp versus a C Corp versus an LLC versus a partnership?
Well, I think about 2 primary things here. One is that, generally speaking, S corporations and C corporations, because of their corporate entities, the buy-sell agreement or the shareholder agreement is usually a separate document that you negotiate. Maybe when the business is being formed or sometimes long after it's been formed. The LLC agreement or a partnership, they're governed by an operating agreement, which oftentimes is created right at the time. And so my suggestion would be think about these things when you're forming an LLC. If you've got this germ of an idea, you're starting a new business, think about some of these especially transfer restrictions, purchase price formulas, that sort of stuff. If you've got multiple shareholders, Terry said at the beginning, it's like a prenup. And one way it's like a prenup, if you do it at the beginning, is you all still love each other at that time, right? So you're thinking about things in a positive way. You're optimistic about the business. Whereas when a dispute erupts, sometimes you're not trying to think about what's best for the company. You're trying to think about how to hurt the other person. So that would be one suggestion, is just to think about building these things into an LLC or a partnership agreement at the beginning and doing a separate agreement if you've got a corporation. The other one is that S corporations are the only one on that list that have limitations on who can be a shareholder. And since I'm a trust lawyer, I think about trusts all the time. We do trusts for planning, all different kinds of planning reasons. And S corporations can only be owned by certain kinds of trusts, or trusts that make certain elections or have certain provisions. So if planning is part of the future for this business, LLCs, C corporations, partnerships, you can transfer those to trust easily. S corporations, you need to think about. And then, of course, C corporations, everybody knows, distributions of cash out of a C corporation are taxable. Whereas with these others, they're pass-throughs, the tax consequences flow through to the owners. So just being sensitive to that, it's sort of a business formation question, but in some ways it's about the operation. How are we going to fund purchase prices and that sort of thing?
Right. Good. Exactly. Thank you. Let's talk for a minute about, one of the questions, thank you to Paul, what is the best way to ensure that the partner that gets bought out for large amounts gets paid what is due? Well, in a death situation, it is using some sort of life insurance. Let's talk for a minute about when does it make sense to use a life insurance to fund a buy-sell? So Susan, why don't you take that question initially, and let me unmute you here. Okay, there we go.
I'm unmuting myself. Hi, everybody. So, well, there's really competing things that you're thinking about when you're using life insurance. And the first question always is it going to be cost effective? So Obviously, the benefit of life insurance is that you receive a lump sum to buy out your obligation, but you're also comparing that against the cost of the premiums. So, for example, if you have business owners that for some reason are uninsurable, in that case, it may not make a lot of sense. The other thing that you would think about is life insurance premiums are generally not deductible, and you weigh that against the fact that if you were to get another sort of loan, say the buy-sell obligation comes due and you have to use credit to pay out the buy-sell obligation lump sum, you would weigh the premium costs against what you think the potential interest cost would be of obtaining that credit to pay the buy-sell out. And then, so it's sort of, you're doing a very careful balance of weighing these two costs of which makes the most sense for this individual business and these individual owners.
Good, thank you. Mike, do you want to speak a minute to what are additional issues that are raised by funding a buy-sell agreement with life insurance? Who should own the policy? Should it potentially be owned by the company on behalf of the individuals, owned by the individuals kind of as cross-purchase? Why don't you talk about that for a minute?
Well, I hate to be a lawyer and say it depends, but of course it depends. And part of what I think it depends on is what style of purchase you have. For example, a buy-sell agreement can require the redemption of the stock, the company buying the shares back from the deceased shareholder's estate, or it can be a cross-purchase obligation where the other shareholders have an obligation to purchase the shares from the deceased shareholder's estate. And of course, it can be a combination of the two, which we call a hybrid style agreement. And so there are several ways you go about thinking about those choices. One is, Susan was mentioning before, that the cost of the premiums can be a factor. It certainly is also true that an older shareholder is going to be more expensive to insure than a younger one. And so if one of the goals of a buy-sell agreement is to facilitate the transfer of a business from an older, say, founder to a younger partner, is it really fair to require the younger person to buy the insurance on the expensive older guy and to have the older shareholder buy the insurance, the cheap insurance, on the younger person? Or is it better to have the company pay the premiums on both, and that sort of evens things out? The other question is, does that younger shareholder necessarily have the liquidity or the cash on hand to pay those expensive premiums? And since it's more critical to that older client who's closer to one of the 5 Ds than the younger one, to make sure that those premiums actually get paid and that the death benefit is there. Maybe that shareholder wants to make sure those premiums are paid, doesn't want to trust this other shareholder to pay the premiums. So in that sense, it may be better to have the company own the insurance. One of the downsides of that, though, is that the cash that comes into the company is now an asset of the company and is therefore available to the company's creditors. So think about that risk as, if the business is in a risky area and suddenly you have $10 million of cash, that could be soaked up by a claim and not available for the purchase of the shares. So think about that risk. And then finally, there's a difference in the tax treatment. When the company redeems a shareholder's stock, the shareholder doesn't get credit for their basis, whereas if the other shareholders don't get basis credit for the increase in their pro rata ownership of the company. Whereas if a cross purchase happens, everybody gets basis credit for their purchase price, and the company or the owner is given capital gain treatment on the sale. So there's lots of things to think about. I'd say choosing the style of agreement, whether it's a redemption or a cross purchase or a hybrid of the two, is one of the key questions, especially for an estate planning driven buy-sell agreement.
Yeah, excellent. Thank you. Adam, let's talk for a minute about best practices in funding a buy-sell agreement and how we would approach that from a collaborative angle. Who would be involved in the discussions of how we're going to fund a buy-sell agreement?
Yeah, I think we would typically recommend a team of advisors be involved in creation of a buy-sell. And as you and Mike have alluded to, it would hopefully be at the beginning or the formation stage of the company. And those advisors would include typically the company's attorney or an attorney representing the company, an insurance agent, probably a life insurance agent, a CPA or tax advisor, a financial advisor or planner, a valuation professional, and that would be kind of the general buckets of types of professionals that would collaborate on a buy sell. Also, as each individual owner, it is probably in your best interest to have your own individual representation, potentially in one or more of those buckets, because the individuals representing the company may have interests that aren't necessarily directly in line with where you stand with the position, was where you stand in the company, whether you are a majority or minority shareholder.
Hey, Adam, could I suggest one additional person you might invite to that party? And that would be the banker, especially for a business that gets a lot of its capital from a lender. A lot of times they're very interested to know what's going to happen if somebody dies, because they want to know how they're going to get paid back. They may be asked to finance this. So I think having the banker, the more intimately they know your business, the better partner they're going to be able to be. So don't forget your friendly neighborhood banker.
Let me add one more question.
Banker.
Oh, go ahead, Susan. Go ahead.
I was just teasing him for being a former banker.
Oh, there you go. There you go. So I've got one question that just came in from Diane Ross Hansen, and she wants to know, when funding a cross purchase between multiple owners, how do you mitigate the number of policies required? Does everybody have a separate policy? And how does that work? So I don't know, Mike, maybe you want to speak to that first.
I'll take that one. Yeah, let's say you have five business owners. I did one of these for a medical practice. So we had 5 physicians. And if you did it as a cross purchase, each one of the physicians would have to have 4 policies, right? One on each of the others. So you're talking about 20 policies. And so what I did in that case was I created a sibling entity. I didn't want the practice owning the insurance policies because of the risk I said before of making that cash available to creditors. So I created a sibling partnership that had special allocation provisions. That partnership was owned by the owners of the operating business in proportionate shares. And it said that when one of the shareholders dies, all of the cash proceeds from the insurance are allocated to the other 4 owners ratably. And then that was a distribution that they received that they could use to fund the cross purchase. And that way we only had to buy 5 policies rather than buying 20. And we had to come up with a mechanism to get money from the operating company into the partnership to fund the premiums. And so what we did was figured out a way to make distributions over, which were treated as distributions to the owners, but then contributed directly into the partnership that owned the insurance policy. So that was an effective way to do it, and it minimized the amount of paper shuffling that we had to manage.
Well, and creative as well. Let's switch gears for a minute. Adam, why don't you talk to us for a minute about the considerations and protections that individuals should be aware of if they're either the majority owner or a minority owner?
Yeah, I think initially when you're starting a new company, you want to understand who are going to be the owners and what percentage each owner will own in the company and how many outstanding shares of stock there'll be, because you just want to know where you're positioned, where you fall as a majority owner or minority owner, or if it's a 50-50 situation. The same consideration would be given if you were entering, buying into a company that was already established. That's probably the first thing you'd want to find out. Then from there, I would probably look at the board or management structure and understand, based upon your ownership, right, what ability you have to control management or have a seat at the table. A lot of times there'll be provisions in a buy-sell agreement that will allow a shareholder for so long as they hold X percentage of shares, or so long as they hold shares, they will get a certain number of seats at the table on the board. So many times if there's 2 owners and it's 60-40, the 60% owner may get 2 seats at the table and the 40% owner gets 1. So those are considerations to think about from each side. As the majority owner, you want as much control as you can get over the board, and as a minority owner, you're trying to get as much representation as you can get and maximize that.
And I think, go ahead, Adam.
Oh no, yeah, go ahead.
Well, I was going to say is, so the thing everybody needs to understand as well, when people talk about buy-sell agreements, they don't always mean the same things. Buy-sell agreements very literally are how shares or equity interests get transferred from one party to another. They often have provisions, as Adam was just referring to, about governance as well. And it's not a bad practice to have the buy-sell agreement kind of contain those governance provisions as well, because it all talks to transition and how the company's going to be run. Susan, why don't you, this kind of brings us into another question about what do you do if there's a dispute? What are the best ways to resolve disputes?
Well, so there's two kinds of disputes. The key dispute that happens the most, obviously, is about valuation, and we'll address that in a separate question. But for non-valuation related disputes, sort of the terms that you generally concede in these agreements are perhaps there's an agreement that will arbitrate. Will the arbitration be binding? Will we apply the American Association of Arbitration rules for selecting the binder, arbitrator? You also sometimes see mediation requirements, and sometimes you'll see the requirement that you meet and confer before anyone commences any litigation. So it can really be one of the three. I think that the trend more recently is that you just see more of these agreements that are requiring that there's arbitration before anyone is allowed to litigate. The idea being that creates a cost savings and puts pressure on individuals to agree. We can go back and forth about whether or not we agree that those incentives are actually created, but that's generally why those sort of terms are included.
Yeah, I mean, I think back in the day, I think there was a thought that arbitration was better, faster, cheaper. Now it's kind of like a mini trial. And so the biggest advantage to an arbitration is you pick your judge.
Right.
Probably the biggest disadvantage is there's no appeal.
Right.
So, I mean, I think we kind of go both ways in those sort of things. I had a situation the other day where I tried to provide for a mandatory mediation and the other side just refused, which was sort of an odd sort of situation. So we're trying to get to the bottom of that one. So Adam, why don't you talk for a minute about if you have a buy-sell prepared by company's counsel, should an owner get their own counsel to represent it? Let's say, let me tee up the hypothetical, 3 owners, 1 owns a majority, 2 own a minority interest, company counsel drafts the agreement. What should the 3 individuals do?
Yeah, I think that each of those individuals should have their own respective attorney look at the agreement from their perspective. And they're going to look at it from, certain anti-dilution provisions like preemptive rights or rights of first refusal. So when there's new shares issued or based upon the sale of existing stock, it's always important to have your own attorney look at it from your point of view, because the company's attorney is taking the pen with the company's best interest and in balancing, I would say, the interests of the owners. So looking at it with that through that lens of your respective position, looking at puts and calls, whether there's a tag or piggyback rights, drag along rights, things like that would be important to look at and have your own counsel review to make sure you both are your views are being expressed in the agreement to the extent they can, but also that they're explaining to you what the words mean to you from your perspective.
Good, thank you.
Mm-hmm.
So this question for all of you, what's worse, no buy-sell or a horrible buy-sell? Mike, why don't you start?
Wow. Gee, which would you rather do? Cut off your arm or cut off your leg?
Cut off your arm and your leg.
And your leg, right. I suppose the advantage of having an agreement at all is that then you can bargain in the shadow of the agreement, so to speak. I think that's one of the things you were talking about with that Russian roulette provision. You don't see it used very often, but because it's there, it can sort of move the parties toward conversation rather than toward getting dug in. But really, if you don't have an agreement, you do have an agreement. You have the statutes, you have the law, and sometimes those things they're straight majority rule, and they really make it hard for the minority to get represented, especially in an LLC or a partnership. So I would say, oh gosh, that's a tough one. I'd say have a good one. Call us. That would be my answer.
Adam or Susan, what do you guys think?
I think it's better to have a bad buy sell than no buy sell is what I would say, because like Mike said, it creates the terms around which you can create the conversation. Whereas if you're in a straight majority situation, it's very hard to get things moving. So I think that even having a bad agreement operates as a catalyst to move these sorts of things forward.
Yeah. Okay. Fair enough. Fair enough. Adam, your thoughts?
Yeah. No, I would agree exactly with
All
what
right.
Susan was saying and Mike was saying.
Excellent. All right, Mike. So we've talked about the 5 Ds, which are typically triggering events that require some sort of action with respect to shares or units. You want to talk about other sort of minor Ds that might cause some sort of transfer?
Well, because I'm an estate planner, what I deal with a lot is, can I give this owner's shares to a trust? Can I give them to children or grandchildren? Can I give them to a foundation? That sort of thing. And so the restrictions or rules around transfers to me are extremely important. If a purpose of a shareholder agreement or a buy-sell agreement is to have some control over who your business partners are. As you said, Terry, I've had many business owners say, I like my business partner, but I don't want to be in business with his wife or with her husband. So being able to prevent the shares from being given to a stepbrother or a charity or something like that is extremely valuable. So I think transfer restrictions and who are permitted transferees and who are not is one of the most important ones. The other one to think about if you have an S corporation is to have provisions that protect your S election. So preventing transfers to a trust that doesn't qualify as an S corporation shareholder, or to a subsidiary, something like that, or to a partnership as a holding company. Those kinds of protective provisions are really useful too.
Excellent. Susan, you want to talk for a few minutes about the different valuation methods used in a buy-sell agreement?
Sure. So like I said earlier, this is really the big dispute that comes about when you're involved in one of the 5 Ds, which is how do you value the business? So there's a few different methods that we typically see in buy-sell agreements. So one of them is formula pricing, where sometimes you'll see that the business will set a formula that they believe fairly will reflect the value of the business. Sometimes it will refer to book value plus a percentage. Sometimes it will refer to EBITDA. It just kind of depends. What I would say about formula value in general is that it can seem really good at the time because it will save you the appraiser money, but long term, it's very unlikely that a formula is fair to both parties because it's very difficult to predict how business conditions will change and how your business will change. And if you're not going to be amending your buy-sell regularly, you may not incorporate those terms by changing the formula. The other method that we see a lot is appraisal, but appraisal methods can be performed in a few different ways. So there can be a single appraiser that's selected at the time of the triggering event that gives a binding appraisal. There can be a single appraiser that's selected at the time of buy-sell. Mike and I recently dealt with an agreement that had that, and the appraiser was no longer practicing. So then what do you do if the appraiser is no longer available? You also see the method where each buyer and seller get to select appraisers. Those two can select a third appraiser, and then that person will perform an appraisal. Or sometimes you see a method where buyer gets an appraisal and then seller gets an appraisal, and then if they don't agree, they can get a third appraisal. You sometimes see an average of all the appraisals, or you'll see terms where if the values are within a certain range of each other, you average, or if not, you pick another appraiser. So generally, we suggest that the preferred method is to have each buyer and seller select an appraiser who picks a third appraiser who then does a binding valuation. The reason for that is it minimizes the appraiser cost, so you're not ending up in a situation where you're paying for literally 3 appraisals. And also you can split the costs of the appraisers within the valuation methodology. So that section is really key, and sometimes it seems that clients don't focus on the valuation method, which is very odd, particularly in the arena of appraisals. They think, who cares who the appraiser is? But really that is one of the most key parts of the entire buy-sell agreement. And the other thing that you think about beyond picking the appraiser, picking the formula value, or certificate value like Terry described, is what discounts are going to be allowed, what factors are allowed for the appraiser to take into account.
Great. Question now for all three of you. How often should you amend a buy-sell agreement?
I would just lead off by saying you probably want to take a look at it annually and then look at major events in the life cycle of the company, whether that's death, disability, divorce, or the issuance of new shares by the company, the transfer of shares among the company, or redemption. Those are instances that are major changes to the company, where the company may look one way on day one, and 20 days later it looks different. That could change the terms or reasons, could provide reason that you would want to change the agreement because the company just looks different.
How about Mike or Susan? What do you guys think?
Well, if nothing else has changed, as Adam said, if you haven't brought in new investors or changed the capital structure in some way, at least every 3 to 5 years, I would say read through it and check up with your lawyer. We like seeing people anyway, so just give us a call.
Susan, how about you?
I think that you should do it annually when you're doing your tax planning for the year. I think you should just make that part of that process, because one of the things that can really impact a buy-sell is whether the value of your business has changed. It can change the lenses that you use to look at the buy-sell agreement. So I think that that's the best time.
Excellent.
In addition to the events that Adam described.
Okay, we're gonna end with a question from Paul Ponson. Let me just read it here. Once an arbitrator has made a decision and awarded the business to one party, what can the other party do when the first party does not exercise good faith and follow through on specific timelines that were given in arbitration? In this specific case, it appears the party awarded the stock has no intention of ever following through on the settled upon agreement. If they agree to binding arbitration, do they then go to court? Is that their only option? When do you guys want to jump in on that one? Mike?
But yeah, I mean, it seems to me that you've got a binding arbitral award, and the person's not following through. You take them to court to have that award enforced. And if the threat of that doesn't get the person off the dime, then they're just saying, look, sue me. It's foolish for them to feel that way, but that's what courts are for, right? I mean, in some ways.
Good answer. Excellent. So, okay, last question from Bob Morris. For appraisals evaluation, is it common to take advantage of a financial institution's approved appraisal list if it is financed, if the business has been financed? So often they may not, the individuals may not have an appraiser and it would be arm's length. Is that a factor? Susan, what do you think?
I think the biggest question there is how critical and key is the bank's support of the number you're coming up with, because like anything, the golden rule applies, right? The one with the gold makes the rules, and so I think keep your bank happy. But if that's not the case, if it's just sort of, well, here's our list of people, just run it by your other advisors and make sure that they don't get hives from any of the names. But I think it's, as you said at the very beginning, Julie, this is your network, and having a list of appraisers that you work with that you like is useful, and you might meet somebody new that you haven't worked with before by using the one recommended by the bank. So I think just as long as there's no red flags, it can be okay to use somebody that other people have a relationship with. I suppose watch out for kickbacks, but I think banks are so regulated that I wouldn't worry about it.
Okay. All right. Julie, I'm going to turn it back to you.
All right. Well, boy, this was great. We could probably go on for a while yet, right? Because there's always new questions that spur other questions, and there's so much to know on this topic. But thank you for presenting. You guys did a great job. The slides will be made available, and there will be a recording that gets sent out. We will also post that recording to our YouTube channel. But I just wanted to encourage everyone who is here on the call, all the members, to really tap into the expertise of the EPI chapter. There's so much knowledge not just in the people that are attending here and now, but for the folks that regularly come to the chapter meetings and have been coming for years. Go there first. Use the expertise of our sponsors, use the expertise of the members. You don't need to go any further. Everything you need is there. Just to kind of echo what Adam said about having a collaborative team and who needs to be on the team. Everyone that you need for a team, regardless of whether the transition is internal or external, you can find through the EPI chapter. So just wanted to say thanks for being here. Please, if you haven't already, like us or follow us on LinkedIn. We do have a Twin Cities metro area chapter page, and you can get more information about EPI globally through that, as well as news and connecting with other people who are in the chapter. Set up some time to meet with each other. We'd love to see more collaboration amongst chapter members. We have no meeting in July. We do have a sponsors and steering committee event, but the next chapter meeting is going to be actually a two-part series in August and September. So you're not going to want to miss that because it's on collaboration. And so we have a National Speakers Association member who's going to be presenting in August. And then in September, we have some chapter members who are going to be forming a panel to talk about actual cases that they've worked on where collaboration made all the difference. Because we really are here to help our business owner clients and help to derive the best possible outcome for their transition. So again, thanks everyone. Let me know if you have any other questions or emails, or you can always contact the panelists, and have a great week and a wonderful summer. We'll see you soon.
Thank you.
Bye everyone.